So let's talk first about the lower loan loss provisions. When it comes to impairments, you say that you see them as lower in the second half than the first half. Would you say that the worst is behind you?
Well, first of all, good morning, Nara. What we said is that if economic conditions don't deteriorate and if the efficacy of the various government support programs that have been quite effective across the world and in many of our markets, if that efficacy is maintained to some degree, then we would expect that loan losses could be lower in the second half of the year. But there's a lot of buts in there, and to call the end to the most challenging period would be premature at this point. We certainly see economic stresses continuing to be very, very present. In particular, I think even in the markets that we have, where we have our biggest operations, so in Greater China and North Asia, where they were the first into the pandemic, but also the first out in terms of recovery, we're seeing that while the recovery has been strong from a very low point, economic activity is still subdued. And of course, we're also seeing in the very important markets for us, like Hong Kong, that what we're calling a third wave of the pandemic has actually been the most severe. And the economic pressures coming from that will linger for some time. So too early to call the end of the pandemic, but what we can say is that Standard Chartered's balance sheet is in good shape, that we've taken what we think are prudent provisions, and that we think that should hold us in good stead through the expected course of the economic recovery in terms of loan impairments being lower in the second half than the first half.
Yeah, and Bill, the fact that you talk about economic stresses continuing to be present, you've also said today it could take longer to achieve your 10% return on tangible equity target. So I wonder what that means for cost cuts. We've reported that you're planning several hundred job cuts worldwide. Are significant job cuts on the cards?
You know, what we said early in the pandemic back in March was that we would make no redundancies as a result of the pandemic, and we have not. We said that we would resume the ongoing transformation of our bank, which has been going on for years. This is automating processes. It's digitizing everything from end to end. It's repositioning the way that our branches operate to be more advice and consultation centers, and to a lesser extent, pure transaction centers, as more and more is happening online. And while we put those transformation efforts on hold during the most acute phase of the pandemic, as our markets are beginning to recover, and many are recovering healthily at this point, as we just discussed, we will continue with our transformation activities. But the most important thing for us is to give every single one of our employees a chance to thrive inside Standard Chartered and not have them forced to leave. And the best way to do that is to focus on reskilling. So we've made massive investments in development and learning tools for our employees so that they have the best possible chance of being redeployed inside the organization rather than outside. Now, inevitably, some people will either choose to leave or we won't be able to find the right job for some people. But we're talking about a very small number of people in the context of our 100,000 full-time workers at Standard Chartered. So, yeah, we will continue to transform our business. The other thing we said, Nara, is that nobody at Standard Chartered will miss a paycheck in 2020. So anybody that does, at the end of our process, having made every attempt to redeploy and reskill, anybody that does leave will be paid a full salary for the entirety of 2020, in addition to any redundancy payment to which they're entitled, which we think is only the right thing to do in an environment like this one.
So, Bill, can I just confirm then, because you've said that there's a possibility that just a very small number of roles might go. Does that mean that there will or there won't be several hundred job cuts?
As I said, we will continue to transform our business. There may be some redundancies as part of that, but it's very small in the context of our employee base.
OK, makes sense. Thank you. You also said today that Standard Chartered hopes to reinstate the dividend as soon as possible. So I'm wondering, should shareholders expect a resumption of dividends and buybacks before next year, Bill?
First of all, that's something that we will be consulting on with our regulators. And the regulators have said that the PRA in particular in the UK has said that they will only consider this in the fourth quarter of this year. But our approach to returning capital to shareholders has always been, first and foremost, make sure that we've got a strong, healthy balance sheet. And I'm very happy that in this quarter's results, in the first half results, that we reported a core common equity tier 1 ratio of 14.3%. This is a very strong, very strong capital number. Together with very strong liquidity, leaves us very confident that we've got the right capital base to weather whatever comes ahead in terms of the economic-related stresses. Second is we've maintained a very healthy investment program in our business. So our first priority is to invest in growth. We operate in growth markets. These growth markets are recovering. We want to make sure that we are fully prepared to capture that. We would like to restore the dividend at the appropriate time, and we'll do that together with in consultation with our regulators. And to the extent that we've got a surplus above all that, then we will look at other ways to return capital to shareholders, very much as we were doing before the beginning of the pandemic, when we had an active stock buyback program. So we're certainly operating at a capital range now that's above our target capital range. We think that's appropriate, given the environment. But as the environment normalizes, and we have every confidence that it will over the coming 6 months to 12 months, then we will look for ways to redeploy that capital.
Bill, you were also talking about the challenges in a big market for you, which is Hong Kong, on terms of economic challenges. But I want to ask you about China's security law, because one of your largest shareholders, Aviva Investors, said it was uneasy about Standard Chartered's decision to endorse China's security law. Have other investors expressed concern with that decision?
What we said very specifically was that we were hopeful that the national security law in China could help support peace and economic stability and social stability in Hong Kong. And we stated that we were sure that that could happen to the extent that the one country, two systems feature of the relationship between Hong Kong and the rest of China was protected. That's what we said, and we're happy to see that the statements coming out of both Hong Kong and the PRC are that the one country, two systems will be supported. So we remain hopeful that the national security law can help to usher in a period of economic and social stability.
Yeah, so I understand that you remain hopeful for that, but do investors share your hope, or are you getting pushback from investors on that decision, Bill?
It would be hard for me to see that an investor wouldn't support a hope for economic stability and social stability. It's our biggest market. A period of stability would be helpful. It is certainly something to hope for. When we look at Hong Kong is in quite a severe recession right now. It began with the administrations last year. COVID obviously has made it a substantially more severe recession. The economic figures coming out of Hong Kong this week were pretty negative. And this is a time that I'm sure that investors would hope for economic and social stability in what is otherwise a very vibrant and dynamic economy.
Bill, were you under much pressure from China to endorse the security law?
The decisions that we take in terms of our expressions of hope for economic and social stability are entirely our own. And I think it almost goes without saying that this is something that we would hope for. I think it's the most reassuring thing for me, and I think for all of us and for the market, and part of the reason that Hong Kong has remained a target for capital with massive capital raising flows going through Hong Kong in the past couple of months, both from Chinese companies and others, is because there was a strong endorsement of the one country, two systems approach. And with a strong deference to the Hong Kong rule of law, the Hong Kong judiciary. These are the important considerations for the success of Hong Kong as a financial center. And I think investors welcome that.
Right, that's interesting. So in that case then, Bill, do you see Hong Kong becoming a less important market to you over time as a result of the security law? For example, perhaps with a shift to business to Singapore?
Look, we have a big business in Singapore as well. Singapore has some tremendous advantages, and Singapore will continue to thrive. Hong Kong will continue to thrive. Hong Kong is the gateway for capital into and out of China, and it's also an extremely important regional hub, both for financial services, but also for trade more broadly. And there's nothing that we've seen in terms of the actions in Hong Kong or elsewhere that suggests to us that that's going to change anytime soon.
OK. In terms of the Hong Kong dollar peg, Bill, of course, with tensions between the US and China rising, one thing that's sort of been tabled potentially is the US going ahead with undermining the Hong Kong dollar peg. Are you looking at scenarios in which that might happen? Is it looking more likely for you this year?
I don't think so. I think, first of all, the Hong Kong peg is extremely well supported with monetary reserves in Hong Kong. Over 2 times the money stock is held in foreign currency reserves. So I think we could say pretty safely that the Hong Kong dollar peg is unassailable. That doesn't mean that somebody won't try to assail it at some point, but I don't think it would be successful. And I'm not sure what purpose it would serve in any case. At the end of the day, Hong Kong is an integral part of the global financial system. And attempts to undermine Hong Kong, I'm afraid, would have some pretty deleterious effects on the financial system more broadly. And it's hard to see any policymaker in the world thinking that's a good thing to do anytime, but particularly now during a pandemic.
And Bill, more generally, with tensions rising in the past few months between the US and China, how do you see those relations evolving, particularly with regard to the Phase 1 trade deal?
Well, it's encouraging to see that the trade deal is still in place, because the tensions and the diplomatic back and forth suggest that things are getting quite a bit worse. And obviously, we're going into the election period in the U.S. And if there's an issue where the U.S. where the Democrats and the Republicans are aligned, it's on a need to be relatively tough with China. So I think we can expect those tensions to probably at best stay stable and possibly get worse. It could impact the Phase 1 trade deal, although I think that was a deal struck in the interest of both parties, and as a result, it hasn't been particularly threatened or canceled. But clearly the rhetoric will pick up, and all we can hope for and encourage is the restoration of a sense of collaboration between the 2 leading economies in the world and the 2 substantial superpowers in the world. The world is in a tough place economically. The tensions that are arising as a result of the trade rhetoric and security tensions is undermining confidence. And at a time when we're trying to recover from a pandemic, that's particularly unhelpful. So all we can hope for is that the leaders of these countries come back together and find a way to get back to the discussion table.
Bill, let me turn to another very important topic, which is diversity. And I'm wondering, in what ways are you currently promoting women, but also ethnic minorities upwards in your company? Yeah, I'm very proud of our track record on diversity, and also on the programs that we have in place to improve our diversity further. Our board and our senior management team have I don't know, maybe the highest proportion of women of any major financial services company, or well over 30%, and that's something that we're proud of. We haven't had to take any extraordinary steps to do that, other than make sure that we are completely open-minded in developing women from an early stage of their careers, and of course bringing women in where we have the opportunity. The focus has increasingly shifted to not just the gender diversity, but also diversity around race, religion. We are an extremely diverse organization, and the population of Standard Chartered spans 140 countries, people from 140 countries, pretty much every religion that we can think of. And but that is not all perfectly reflected at both our board and at our most senior management levels. So we're continuing to develop people throughout our ranks. Very, very active programs. Our diversity program is chaired by Simon Cooper, who runs our corporate bank. Together with the rest of our management team, we've got a series of programs to make sure that we identify talent at an early stage, develop that talent, move them around our network, give them every opportunity to succeed, together with, I think, the conventional programs around trying to root out certainly any remaining conscious bias, but the more insidious challenge is unconscious bias, as we know, where we are very, very aggressively going after the opportunities to improve. That's great to know, Bill. Just finally, I want to ask you about your role. You've been leading Standard Chartered for 5 years. Of course, questions start to be asked behind the scenes about whether you're thinking about life after Standard Chartered. We reported this month that Barclays is gauging interest for Jez Staley's role. Have you been approached by Barclays?
Obviously, I wouldn't comment on anything in particular, but my job is at Standard Chartered. I have quite a task right now, and we're very happy with our first half results, with income up, costs down, capital very strong, and with a loan impairments which, while elevated relative to earlier periods, has come down in the second quarter relative to the first, and that's all good news. The bad news is the economy is in tough shape, and the operational challenges on our business are substantial. And my task is not complete. So my focus is on Standard Chartered and getting that job done.